Hey everybody, welcome back to another video. Today's video is very exciting. It's a little bit different from our usual stock analysis, trading ideas, options trading, etc. Today we are going to focus on long-term investing. I'm going to show you a portfolio and all the stocks within that portfolio, and I'm also going to show you the percentage gain and loss. And then I'm going to provide you my observations on this portfolio and my recommendations on how to improve the portfolio performance. Somebody who reached out to me and asked me to help them with their portfolio, as they are a busy individual and they do not have enough time to day-to-day management of their portfolio. So by sharing the observations and recommendations that I will be applying on this portfolio, this may help you managing your own portfolio. If you enjoyed today's video, make sure to give us a like so the video can be pushed out to more people and they can take benefit from these observations. This is going to be a long-term investing goal, and that is why we are looking at this portfolio from a long-term standpoint. So without further ado, let's dive in. All right, let's get straight into the portfolio review. This is the portfolio composition. Meta is about 17%. Shopify is about 12.7%. I believe SPAX is the cash in the account, 12.6%. IVV is 11.7%. IVV is your S&P 500 index fund. And then they have BA, that's Boeing, 8.9%, ZOM, which is ExxonMobil, 6.2%, Oxy, and so on and so forth. Next up, we'll take a look at the total gain loss percentage. So the biggest gainer for this portfolio is Meta at 195%. Next up is Shopify, about 50%, and then you get into the 21% for IVV. Netflix is 113%. They also have RCL, I believe that's Royal Caribbean. It's 240% gain, but it's only 1% of the account. Some of them have performed very nicely, but they also have a big losses here. So we can see the loss in Boeing, which is 9% of the account, is about 15%. And I can understand why Boeing is in a loss. Currently, Boeing is having a lot of controversies with their safety concerns with the 737 MAX, and it's been going on for a couple of years now. It's definitely not been helpful for the Boeing stock in general. Beyond Meat here, which is about 0.5% of the account, and they have lost about 88%. Peloton is down 80%. This was how the portfolio is currently structured. Next up is observations of this portfolio. My first observation by looking at the portfolio is that they have too many stocks in the portfolio. We have about 27 stocks in the portfolio, which seems like the person who owns this portfolio tried to diversify, ended up with such a large number of stocks in the portfolio. The general con of having too many stocks in a portfolio is that it is humanly impossible for you to manage 27 companies and be able to go through their earnings report or even track those companies on how they are performing. So that was my first observation. The second observation is that the portfolio has exposure to S&P 500. However, it is at number 4, which I believe should be improved, and S&P 500 exposure should be number 1 from a portfolio composition standpoint. It would also do good have exposure to NASDAQ and preferably small cap if they would like a Russell 2000 IWM, but the bare minimum I would say you should have an exposure to both S&P 500 and NASDAQ. This is again my opinion on how I think a long-term investing should be done. The third observation is the portfolio does have exposure to the Magnificent 7, which is in the tech sector. So taking a cue from the NASDAQ ETF standpoint, at least the good news is that the portfolio has tried to add the Magnificent 7, have a tech exposure in Meta, in Google, and in Netflix. The concern is that except Meta, which is the biggest position in the portfolio, Google only is about 3.12% and Netflix only stands to about 2.83%. So any major moves in these two stocks will not impact the portfolio in any significant way. Now, I may be biased because I like to invest in tech, but I do believe that this portfolio will do better if they increase their exposure to the Magnificent 7, or they could look into getting into the ETF for NASDAQ, which is QQQ or something similar. The fourth observation is this portfolio has too many hyper growth stocks, and what it reminds me is of a portfolio that is a very 2020-2021 type portfolio. What do I mean by that? So in 2020 and 2021 we had just a lot of companies going IPO either via regular IPO or by SPAC, and every stock was going to the moon. Couple examples we can see from here is AMC, we can see Beyond Meat, we can see Peloton, we can see Teladoc. These are the big names that were very popular among retail investors back in 2020 and 2021. The problem is that a lot of these stocks are now down 50, 60, 70% in the portfolio, which leads to my next point. This portfolio has a very poor risk management. What I mean by that is there is no stop loss. Now, stop loss concept is just not for trading. It can also be used for investing purposes. And it seems like that this portfolio has not followed that. And this is the reason why some of these stocks are down almost 90%, like ACB is down 89.59%, Billy is down 88.46%. And that is the reason why the percentage of the account has also gone down, because the value that you had invested initially is down 90%. This is why we see such major losses in the portfolio. I also believe not sure about the entry and the exit criteria for their investment. Now, generally when you're investing in S&P 500, it's buy and hold for long term. Also, when you're investing in much more stable companies, whether it's like dividend companies like 3M or Coca-Cola, or tech names like Apple, Amazon, those stocks are also in the buy and hold category. But then there are stocks which are hyper growth stocks you see in the portfolio, like Billy or Lyft or AMC or Beyond Meat. They had their run. When you're investing in hyper growth stocks, you need to have an entry and exit criteria clearly defined. And if you don't, this is exactly what happens. So how long it will take for this portfolio to recover for these stocks? Some may never recover, some may take a couple years to recover. The fifth observation is the investment amount seems to be very random, and there is no strategy in place on how you want to build this portfolio out. Basically saying, what is the goal of this portfolio? Is it a growth portfolio? Is it a dividend portfolio? Is it an income portfolio? What exactly is this portfolio trying to convey? Portfolio has been trying to do too many things. Invest in S&P 500 to have a long-term portfolio vision, but also invest in a lot of hyper growth stocks like Zoom, like BigCommerce. Also investing in stocks that are very momentum driven, for example, Tilray or ACB, that were cannabis stocks. Cannabis was trying to become more mainstream. So it seems like the goal is lacking on what exactly this portfolio wants to achieve. The last observation is that this portfolio is not taking advantage of the artificial intelligence boom. The artificial intelligence revolution is a little different from the metaverse that was very popular a year or 2 years back. Taking an advantage in the AI will help this portfolio to recover and and be profitable in the long-term standpoint. They do have Qualcomm, but it's less than a percentage in the portfolio. So even if they gain a lot, it's not going to move the needle for this portfolio. Moving on to the last section on my recommendations on how we can improve this portfolio. So number one suggestion would be to define the goal of this portfolio. What exactly are you trying to achieve with this portfolio? Is it a long-term buy and hold, or is it something generate income from, or is it going to be hyper growth portfolio? And in any case, whatever the goal is, it needs to be defined. Now, second recommendation is to increase your portfolio allocation of S&P 500 to about 25%. So they are about 13% or so. Make that as your number one investment in the portfolio. The third recommendation would be to identify the winners and losers for the long term. The stock portfolio has AMC. In my personal opinion, AMC is not going to be recovering from a loss of 60-70%, and it may take you years, even decades, or may never recover. So it is very important for the individual to identify the stocks they want to hold for long term and divest from the others so they can redistribute that cash into other more profitable investments. Number 4 is tying up with the previous one, reduce your exposure to the meme stocks and the hyper growth stocks. This stock portfolio has a lot of stocks and have a very heavy exposure to the meme or the very hyper growth stocks. Considering it's a long-term investment, if the individual wants to play hyper growth stocks or play those meme stocks, create a different portfolio account and have small cash invested in those meme stocks. But investing in meme stocks in your long-term portfolio is not very helpful, and it will not help you achieve your long-term financial goals. Recommendation number 5, define the entry and exit criteria when you're investing in equities. So unlike adding to your S&P 500 ETF or adding to your NASDAQ ETF, which are more buy and hold for long term, decades after decades, when you're investing in equities, you need to have some kind of a criteria defined for entry and exit so that at least you can take profit profits when you are 600, 700% up, or you are able to cut losses when you're down 30, 40% from initial investment. My last recommendation would be to take advantage of the tech revolution and the AI revolution in your portfolio. And the best way to do that, if you do not want to invest in any more stocks, you can definitely go and get a NASDAQ ETF or a technology ETF, and that will help balance your S&P 500 portfolio with a tech exposure through the tech ETF. I have done a video on tech ETFs and I will link it right over here for you to check it out. And I do plan to make another revised version for 2024 on the latest tech ETF. So definitely check that out as well. Now, as promised in the beginning that I would tell you whose portfolio it is my wife's portfolio. So she finally agreed to let me handle her portfolio from start to finish, and all the recommendations that I provided in this video, I will be applying them on this portfolio in the coming months and quarters. And I really hope that you found some value from the observations and recommendations that I gave. And if you did, make sure to give us a like, click on subscribe and ring the bell notification. I will see you next time, Investor Family, but don't forget to invest for tomorrow.